Hash the Wolf of Wall Street scam. Explain like you're 5. Imagine you're selling baseball cards. You have a card worth $1, but you tell your friend it's worth 10. Your friend tells his friend it's worth 20, and suddenly everyone thinks this little piece of cardboard is a treasure. Then you sell it, pocket the cash, and disappear before anyone figures out the card was never worth more than $1. That's it. That's the whole thing. That's what Jordan Belfort did, except he didn't use baseball cards. He used stocks, and instead of a few friends in a schoolyard, he used thousands of ordinary Americans who trusted him with their savings. The name Jordan Belfort might make you think of Leonardo DiCaprio, quaaludes, and yachts. And sure, the movie is fun. But the real story is more interesting than the movie and more terrifying because the actual scam wasn't complicated. It was almost embarrassingly simple. It worked because of one thing most people never consider. The price of a stock doesn't have to reflect reality. It only has to reflect what people believe. And belief, it turns out, is incredibly easy to manufacture. Let's go back to the early 1990s. Jordan Belfort was in his mid-20s, already fired from a legitimate Wall Street firm and looking for another angle. He found it in penny stocks. Penny stocks are shares in tiny, often obscure companies so small they don't trade on major exchanges like the NYSE or NASDAQ. They trade on what's called the OTC market, over the counter. No strict oversight, no serious regulation, a financial Wild West. These companies might be real. They might be shells, basically empty businesses with no product, no revenue, no future. But here's what matters. Their share price is low, sometimes fractions of a cent, which means with a small amount of money, you can buy a lot of shares. Belfort understood something critical. If you own a huge chunk of shares in a tiny company and you can convince other people to buy in, the price goes up. And when the price goes up, you sell. You walk away rich. The people who bought in last, they hold worthless paper. This is called a pump and dump, and Belfort turned it into an industrial operation. Here's how it worked, step by step. Step 1, acquire shares. Belfort's firm, Stratton Oakmont, would get a position in a small company early, quietly, cheaply. Sometimes they'd work with company insiders. Sometimes they'd essentially create the company themselves, with help from friends. Either way, they owned the stock before anyone else knew it existed. Step 2, create the story. Every pump needs a narrative. The company has a revolutionary technology. It's about to land a massive contract. It's the next Microsoft. The story didn't need to be true. It just needed to sound plausible enough to get someone excited on a cold call. Step 3, the cold call. This is where Stratton Oakmont made its name. Belfort built a boiler room, an office full of aggressive, hungry young salespeople, dialing numbers all day, every day. These weren't licensed financial advisors. Many were barely out of high school, but they were trained to sell, trained to push, trained to handle objections like a script from a movie, because essentially it was a script. A script Belfort wrote himself. They'd call dentists in Ohio, retirees in Florida, small business owners in New Jersey, people who'd never invested in anything more exotic than a savings account. And they'd pitch them this incredible opportunity, this ground floor moment, in a company no one had ever heard of. And it worked. It worked because the pitch sounded professional. Because the caller sounded confident. Because people want to believe there's a secret door into wealth and someone is finally letting them through it. Now here's the math that nobody thinks about until it's too late. Let's say Stratton Oakmont buys 1 million shares in a company at 5 cents a share. That's a $50,000 position. Then they call their clients and push the stock. Demand goes up. The price goes from 5 cents to $2, maybe 3. At $2, that same million shares is worth $2 million. They've turned 50,000 into 2 million, a 4,000% return in weeks, sometimes days. Meanwhile, the clients who bought in at $1, $1.50, $2. They're holding a stock that only had value because Stratton was artificially inflating it. The moment Stratton sells, demand collapses, the price craters. And those clients, the dentist in Ohio, the retiree in Florida, they lose almost everything. The firm charged commissions on the way in, then made money on the manipulation. Then walked away clean while the clients absorbed the losses. One transaction, multiple layers of profit, all at someone else's expense. Belfort eventually had over 1,000 brokers working for him. Stratton Oakmont brought in an estimated $200 million in revenue through the 1990s. By some estimates, the firm defrauded investors out of more than $200 million in total losses. and for a while, nobody stopped them. The SEC investigated. FINRA flagged suspicious trading. But regulators were slow, underfunded, and dealing with a firm that had learned to stay just inside the lines, or just outside them without leaving fingerprints. Belfort was, in his own way, a genius, not a financial genius, a asterisk social genius. He understood that most fraud doesn't require technical sophistication. It requires trust, it requires confidence. And it requires a target who desperately wants to believe the pitch. The FBI eventually caught up with him. In 1999, he pleaded guilty to securities fraud and money laundering. He served 22 months of a 4-year sentence. He was ordered to repay $110 million to defrauded investors. He repaid a fraction of it. Then he became a motivational speaker, wrote a memoir. Sold the rights to Hollywood, made millions more. The victims got pennies on the dollar. If there's an uncomfortable irony at the center of this story, it's that the same charisma that built the scam rebuilt the brand afterward. And the system that was supposed to punish him ended up platforming him. Here's what this story is really about, though. It's not about Jordan Belfort. He's just one person. The boiler room is just one method. The penny stock is just one instrument. The underlying mechanism, manufacture belief, inflate value, exit before the collapse, that mechanism has outlived Stratton Oakmont. You can find its logic in shady crypto projects, in certain SPACs, in social media hype cycles, where influencers pump stocks to millions of followers and then quietly sell their positions. The tools change, the script doesn't, and maybe that's the question worth sitting with. If the scam is this simple, if it's basically just a confidence trick dressed in financial language, why does it keep working? Is it greed? Probably some. Is it desperation? Definitely some. Or is it something harder to admit, that most of us, given the right story told by the right voice at the right moment, might believe the baseball card is worth $10 too?